The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Apple shines, bank stocks fade, and the bond market awaits its fate. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. You know what we got?
What?
17 and a half hours of risk for assets.
Should we put the countdown clock up right now?
Yes, that's
Start
until
it.
we get that
Get it
CPI
going.
at 8:30. That obviously is going to be the market mover. You got options pricing in a swing with the S&P tomorrow. Here's where we're at. Record high for the S&P. We're up just 0.1%, but around the highs of the session. And we're at that record high, helped by Apple at a record high as well. On the downside, we have financials really dragging down here, down by over 1%. Huntington really leading that. They're down by 6 straight days. This is after they had earnings yesterday and their income guidance was a little weak. The 10-year yield also seeing really strong demand, Romaine. Yes, it might be a safe haven bid for sure, but we had that auction at 1 that was also very solid. So raises the question, where's the volatility going to come in 17 and a half hours?
Yeah, 17 and a half hours until that CPI report. And guess what? Well, about 23 hours until we get the big Fed decision. And you could really feel that sense of caution out there in the market today as the Fed did kick off that 2-day policy meeting. And that's against the backdrop of a massive Treasury auction this afternoon and a potentially big CPI report that Alex was just alluding to in the morning. Bill Gross joined us yesterday. Here's his take.
I think the market basically anticipates the Fed to stay, and maybe in September, maybe in December, maybe 1 or 2 cuts.
Well, forecasting the Fed's response, though, that's still looking incredibly futile with government data since the last FOMC meeting showing economic strength and that same data also showing economic weakness. Pick your poison. Data this morning, though, did provide a sliver of hope. U.S. small business optimism, that actually edged up in May. Highest level we've seen all year. Big improvements in the share of owners expecting the economy to improve and big improvements in the share of firms planning to increase hiring. Those are the small businesses. And in a few minutes, we're going to talk about how big business is feeling with the CEO of the global consulting company, AlixPartners. Now, whether business sentiment and the economic vibes are to the Fed's liking or to its chagrin, that remains to be seen. Remember, we're almost a year into the FOMC holding its policy rate in that 5.25% to 5.5% range, and that is a 2-decade high. And investors are getting antsy for tomorrow's update of the Fed's plot of dots, Alex, and which direction that line connecting those dots is going to point.
That's right. And it was what 1 dot would have really changed the median at the last meeting. So this is a great chart we have of the median dots for the end of this year. And that's of the meeting that we saw back in March. They only do this once a quarter. And you can see here, they're expecting 4.6% on that median dot by the end of this year. By the end of 2025, they think that dot will be 3.9%. Now, the question we're now having is, will that change? And will that actually re-rate a little bit higher, which would mean less cuts this year and definitely that higher for longer? Now, also, you have to look to 2025 and the dot plot and that median move. Will we see those 2.5 cuts still priced in that median dot, or will that change as well? And it's continued, Romaine, to be that higher for longer. It does feel like we can get excited about the dots.
Yeah, let's see if things get exciting today or tomorrow. Saira Malik joining us right now, CIO over at Nuveen, to help kick us off to the closing bells here on this Tuesday afternoon. I guess we'll call it Fed Eve, and I guess it's CPI Eve for that matter too, Saira. I mean, do you think that what we're going to learn over these next 24 hours from the economic data and from the Fed's summary of economic projections and the dot plot, do you think we'll finally get a little bit more clarity here about the direction of policy?
We have our 2 for tomorrow with CPI and FOMC data coming out. I think, first of all, with the FOMC, we're going to be watching 2 things: the dot plot and any information that they give us on the direction of inflation. For the dot plot, I think we may see that shift down a little bit to 2 cuts or maybe even less. And also when it comes to inflation, they may be talking a little bit more about inflation remaining sticky and above the Fed's target, because switching over to CPI, that number as well as PCE are still well above the Fed's target, running at about 3% on a core basis year over year. And we're going to be watching auto insurance, which drove CPI higher last month, as well as apparel prices, which drove CPI higher. Those are the 2 areas where we'll be waiting to see, will they cool off a little bit. But as of right now, the Fed's hands are tied. They cannot move to aggressive rate cuts because inflation is so far above their target.
Are investors' hands tied right now, Saira, when you take a look at that?
I think investors are willing to accept this move down in the number of rate cuts as long as the economy remains strong and we see that inflation is not re-accelerating like it was earlier this year. So I'm probably going to be a little bit more focused on that first CPI number we get. Do we see signs of inflation re-accelerating because of, for example, payrolls that were so strong last week and wage inflation that has been strong? If that points to an acceleration in inflation, I think markets will become concerned. So CPI at 0.3% or under that, I think will be okay for the markets. If we move much higher than that, I think the markets get nervous.
And that's why I said 17 and a half hours, some crucial hours for those risk assets. Sarah, the play out today, even though you have the S&P and the NASDAQ at record highs, is still kind of the play, right? Apple doing really well, banks not doing really well. Within the tech space, what is your top buy right now?
Yeah, so first, yields down, banks down. That's not surprising. And today is the day of Apple, and Apple actually is something that we've been positive on for a few reasons. Number one, we had the developers conference yesterday. The anticipation over AI going into the iPhone is exciting. We are reaching year 5 in about a year from now, which is a typical iPhone replacement cycle where people will be wanting to upgrade their iPhone. So we have that cycle in front of us, and seasonality for Apple is strong. Seasonality starting in May, going through September, when we usually get that next iPhone, is usually positive for the stock. And finally, people are underweight Apple because they've been so focused on stocks like Nvidia and Microsoft. So with PMs underweight, I think you could see that pain trade where people have to cover that underweight given the performance we've already seen out of Apple.
I like that you brought up Nvidia because I wondered if it's sort of like buy Apple, not Nvidia right now. It feels like that's the trade, at least today. In that AI space, if you want that direct exposure, what's the top way for you?
I mean, it is Nvidia. There's just limited supply for pure AI players. Nvidia wins in any segment of AI because it's the supplier of everything. And if you look at Nvidia, it's interesting because for a semiconductor stock, it's not expensive. It's trading at a discount to the semiconductor industry. So that pushes back on the bears' arguments of people who say that Nvidia stock has rallied so much that how can you buy it here? It's actually not an expensive stock. It's actually somewhat cheap. And so, it's not sell Apple to buy Nvidia. I think you actually want to own both and maybe sell other stocks in order to buy those.
When you look at sort of the backdrop of the rally that we've seen in Nvidia and really the chip stocks overall, a 28% jump this year so far in the Philadelphia Semiconductor Index, and you look at the laggards in the tech space, which are the software companies that I thought would actually be benefiting from this AI boom, Sarah, is there any hope left for that trade, or are we just kind of abandoning that and just hoping that Nvidia and Jensen Huang and that leather jacket rises to the future?
Well, I think it's interesting to pick through the carnage of software. It has underperformed semiconductors by a little over 45% year to date. There are quality software companies still out there, even given the underperformance that we've seen. So one is Snowflake. This is actually somewhat of an AI play because they clean up companies' data so they can prepare for incorporating artificial intelligence into their models. They had a strong first quarter, some of the best revenue growth we've seen in 2 years. Just hired a new CEO that came from Google's ad business. So these companies, I think is where you should be looking because eventually software will start to have a catch-up trade because it's pretty extreme for software to underperform semis by over 45%.
Sarah, always great to talk to you. Saira Malik there, CIO over at Nuveen, helping us kick you off to the close on a day where we see Nvidia on the back foot, Apple having a record day. It's going to be a big theme of the show today. We're going to talk to Rajiv Jain. He's chairman and CIO over at GQG Partners, a huge holder of Nvidia shares. We're going to get his thoughts on the tech sector and some of the U.S. restrictions on the sale of AI chips to China.
Plus, staying with AI, we're going to talk with Simon Freakley, CEO of AlixPartners, his insight how it's affecting companies around the world and who is getting it right.
And a direct conversation with the C-suite. Cisco betting on Splunk to build its AI portfolio. The CEO of Cisco, Chuck Robbins, is going to be joining us, as is the head of Cisco's go-to-markets business, Gary Steele, the former head of Splunk. All that and more coming up in a bit. This is The Close on Bloomberg.
Rising geopolitical tensions, the impact of AI, the broader macroeconomy, all top of mind for CEOs. That's according to global consulting firm AlixPartners. 41% of executives surveyed in their 2024 disruption survey report instability in interest rates and the inflationary environment to be a threat. We are joined now by their CEO, Simon Freakley. Simon, great to get your perspective. That's a whole big laundry list. It makes our problems look totally different. I mean, like a laundry list of stuff. What's top of mind? What is the thing you hear most from your CEOs?
Well, CEOs thought they were getting a throne. They now found themselves on the hot seat because they've got to deal with multiple disruptions. They have elections coming up, not just in the US, but also now, of course, in France and the UK. Irrespective of the outcome, how are they going to talk to their employees? How are they going to make sure during a stressful time they can communicate a steady message? On top of that, the geopolitical tensions, of course, what it means for supply chain as the Red Sea continues to be disrupted, a continuing war between Russia and Ukraine with the possibility of it spilling over. It's a very stressful time for CEOs. I sometimes joke, Alex, that our disruption index ought to be called the anxiety index because we do see that taking a strain on CEOs.
How do CEOs that maybe operate in China feel about the relationship of the US and China?
Well, I think CEOs generally that I speak to every day are relieved that the toxicity of the dialogue has actually come down a couple of notches. A year ago there was a poisonous dialogue going on, which made it very difficult for business leaders to see a future in China. I think as a result of several very significant business leaders, Jamie Dimon, Elon Musk, Tim Cook going over to China and re-establishing a dialogue, and even now President Xi, of course, reaching out to Joe Biden means that the temperature's come down. I think now corporates can see a future in China, but are still nervous about investment.
Are they nervous about the election, the November election here in the United States?
They certainly are. In our survey every year, 3,200 CEOs, we ask them what's top of mind for them. In the top three concerns is the US election, and not because they're gaming one outcome or another, but how are they going to talk to their constituents, given that it might be a very difficult time in terms of a new administration starting, because 50% of their workforce are not going to be happy. So I think people are worried. How are they going to narrate it? How are they going to talk about it? How can they keep a steady ship through it?
Let's talk about opportunity. We've been talking a lot about AI and the potential promises there. I know we're probably a long way away from a real profitable future for AI, but what are the CEOs telling you about how they're incorporating it? Are they scared of it? Do they see opportunity into it?
So what CEOs I speak to say is, it's now fairly obvious what the efficiency plays are. We all know the stories of how call centers can be reduced by 30% in terms of headcount, radiology reports, etc. What still isn't clear is how AI and generative AI is going to drive growth. And not even the specialists, the Sam Altmans and the Mark Benioffs, have been able to articulate that. So when I'm sitting with CEOs and their teams, probably 70% of their strategy discussions are on what are they going to do about AI, but probably only 4% of their budgets is being spent on it because it's not yet clear. But the best people are doing two things. The best leaders are doing two things. Number one, they're understanding that the winners will be the people that have the best data, not the best large language models. And secondly, they are not getting ahead of investment until it's clear what is the business priority they're serving.
Interesting. So when you say 4% of their budget, how big is that going to get? How big do they anticipate that getting?
Well, I think people are talking now maybe 20%. They see that there's going to be very significant investment in the tools, but the facilities. And of course, the investment won't just be in the large language models, but in the infrastructure and the storage to facilitate the interrogation of the data. So for businesses like Dell, for instance, their best years may still be ahead of them. It's not just NVIDIA, because the infrastructure required to support this investment is going to be huge.
Globally, where do you think CEOs feel the most opportunity to deploy capital?
Well, obviously the major economies continue to be the biggest opportunity, but I think because of the geopolitical disruptions that you referenced a minute ago, I think people are having to be very, very thoughtful about it. How quickly will the Middle East reach resolution, and will supply chains re-establish themselves? How will they think about investing in Europe, which overall has zero growth at the moment? And now with two snap elections and uncertainty as to what happens the other side of those elections, I think it is a very uncertain time for CEOs, but the best CEOs pivot quickly. They don't make themselves a hostage of a strategy that becomes inefficient. They pivot. They do it nearly right, Alex, but they do it now.
But you're describing a very hard job. I mean, the CEO position has always been a hard job, but it's obviously a lot harder now. And we've seen huge turnover in the C-suite. I mean, the CFO turnover is astronomical. We haven't seen anything like this, at least in this most recent economic cycle. And I think the CEO turnover numbers are starting to get up to those levels as well.
Absolutely. So in the S&P 500, 10 years ago, the average tenure was 7.5 years. Now it's 4.6. We're seeing this increasing rate of turnover. I think in May of this year, it's the largest number of CEO replacements in the S&P 500 ever. So it's a stressful job. And it's not that any one thing remain is too difficult. It's just the multiplicity of issues that layer on top of each other that makes it an incredibly stressful job.
All right. Well, this was an incredibly enlightening conversation here. Simon, always great to talk to you.
Great to see you.
And the research you guys are doing there over at AlixPartners, really phenomenal. Simon Freakley, the CEO over at AlixPartners. No relation to Alex Steele.
No, but I like that they're spelled the same way, so that's nice.
Is that why we booked him?
Yes, that's exactly why. But it is interesting because if you turn over CEOs quickly, you may be able to pivot quickly, but then you also don't have any continuity, and then you have to change strategy all the time. And I can't quite tell if that's a good or bad thing for a huge company to do in this time.
Yeah, well, I guess it depends on what your company is.
But that's why I'm not the CEO. So
Boeing, maybe.
Maybe you do need that.
If you're another company, maybe not. All right, we're going to talk a lot more here about some of the big movers on the day. A closer look at Comcast coming up, which actually got its only negative analyst rating earlier today. We're going to talk to the analyst behind that call and what exactly is ailing Comcast. That's coming up next on The Close. This is Bloomberg. Let's get a view from the sell side with our top calls. We're going to take a big look here at the big movers on the back of analyst recommendations, and we're going to start off with Apple, an upgrade today to buy from neutral over at D.A. Davidson. This after the iPhone maker announced new AI features on Monday. D.A. Davidson analyst Gil Luria was on the close immediately after. Take a listen.
It looked good. What Apple showed today was how to build Gen AI into the experiences we're already having, and that's meaningful.
Gil Luria there, shares of Apple right now at record highs on the day. Next up, let's take a look at On Holding. Bernstein starting coverage of the Swiss footwear company with an outperform rating and a $50 price target. The brand seems to have reached its peak, according to the analyst, at least in key global cities, but he says it still has legs, and the stock, while it's pricey, said you'll still be paying for innovation and growth, and that makes it a buy. The share's up 2.5%. Let's end things on the telecom sector with Comcast getting its only sell rating with a downgrade to underperform over at BNP Paribas. This comes in the wake of the U.S. Affordable Connectivity Program ending on June 1st. He says this could create volatility for the cable companies and could tip Comcast over the edge. Those shares down about 1% on the day. Those are some of our top calls as we stick on Comcast, stick on telecoms, and bring in the analyst behind that last call. Sam McHugh joining us right now, head of telecom equity research over at BNP Paribas Exane. And Sam, let's get right to it here. This program, a lot of people aren't familiar with it. This basically subsidized the cost of a lot of broadband service for a lot of folks out there, more than 20 million people. That effectively came to an end as Congress refused to refund it here. How much of an impact is that going to have on the bottom line of Comcast?
Yeah, good afternoon. Thanks for having me. I mean, for Comcast, it's actually not the biggest impact. I think the term we used today was the straw that broke the camel's back. And so it's a part of some headwinds that we already see in their core connectivity business, which has already been under a ton of pressure from fixed wireless access and fiber in the last 2 or 3 years. And so you're looking at kind of low single-digit 100 millions. So again, individually not massive, but it really is a thing that we think will push this business from growing to declining EBITDA in the next 12 to 24 months. Is there not a future for broadband overall? I always thought with these cable companies, whether you're talking about Comcast or Charter, that broadband was kind of the savior to a certain extent, as a lot of us, of course, were cutting the cord on our TV service, but of course, we have a much bigger reliance on internet service. Yeah, look, broadband is certainly a huge, important product for all households. I think the struggles that the cable industry has is that they were just so dominant and so successful for so many years. They didn't face too much competition from fiber providers or fixed wireless access. So this is the 5G home internet from the likes of T-Mobile and Verizon. And our case for the last 2 or 3 years for the whole cable industry is that you've really been through going through a huge structural multi-year shift where cable hasn't become bad per se, but there's just a lot more choice for consumers out there. And particularly in a market where we do see rising price sensitivity, we have these headwinds from ACP, the enticement of moving to a lower price fixed wireless access offer for consumers is actually pretty good. And so they're taking a much bigger share of the cable's business than they perhaps did 2 or 3 years ago. Hey, Sam, where do you think we are in that cycle that you just described? I do feel like the cycle has been quite long in the tooth. Where are we in it? Yeah, I mean, look, you can probably tell from accent I'm not American, but I'm going to use a baseball analogy. And I think we're probably in the 7th or 8th innings of kind of expectations around cable broadband customer growth. Like the street view has become that these cable companies won't get back to growth until 25 or 26. our view is still that we have a longer tail even beyond that, as you see people like T-Mobile expand beyond just fixed wireless access and start to get into the fiber game as well. So, the cable companies still have this pressure over a multi-year time horizon, so that we're not quite at the end of the downgrades, if you like.
Well, that's such a good point, because in some ways, I don't know who Comcast's competitors are anymore.
John, I lost you for 2 seconds.
I was saying,
I'm
not totally clear who Comcast's competitors are anymore, because everyone's doing all the things.
Good. Yeah, so, in terms of doing all the things you're saying, so, the competitors today are really taking an FWA fixed wireless access product from Verizon or AT&T or T-Mobile or an AT&T, bundled package and putting it together with YouTube TV, Netflix, OTT video. So I think the dismantling of the old cable bundle has really opened up the market to a lot more competition from these pure play broadband providers. Whereas in the past, the cable companies really had a nice moat, an advantage with these TV packages that they could sell to the consumer in a way that these other providers couldn't. So that world has really changed, and it's opened up a lot more competition.
So who do you liken, though, in this space, Sam? I mean, we're not really giving up on content. We're not really giving up on anything. It's just kind of how we get it and who delivers it is what's shifting.
Yeah, correct. I think the name we like and we've liked for a really long time is T-Mobile US. So it's a pretty popular consensual name, but in telcos, what you want to try and find, I always think, are white spaces of growth and not companies with legacy exposure who are losing market share. T-Mobile still has a lot of drivers for growth, whether that's in rural market share, the enterprise market where they're still underpenetrated, and then all of this growth in fixed wireless access and fiber. We see a really long multi-year sustained growth story still at T-Mobile, with best-in-class industry cash flow, really good cash flow margins, strong shareholder returns. So for us, T-Mobile has been a top pick for probably 5 or 6 years, and it remains so today.
We only have like 30 seconds, Sam, but you also raised your target on AT&T, though.
Yeah, we did. And so I think one of the good things from the wireless industry's perspective is that churn levels remain very low. Macro sensitivity is increasing slightly, and that's manifesting in very low handset upgrade cycles. So we heard about Apple beforehand. That is very good low handset upgrades for the wireless industry from a cash flow and margin perspective. So some of the worries we'd had around AT&T seeing bigger churn this year driven by a handset replacement cycle have receded a bit versus history, and they have very low exposure to this ACP program. Mm-hmm. So while the rest of the industry will go through some volatility, we think AT&T is fairly immune.
Hey, Sam, we really appreciate it. Thanks so much for jumping on with us. Sam McHugh over at BNP Paribas. And AT&T has a nice 6.2% dividend yield. I liked talking to Bill Gross yesterday, where he was just rattling off stocks with high dividend yields.
And I think it's interesting, too, the call on T-Mobile. We've heard this from some other analysts. A lot of people really starting to warm to that stock as really kind of maybe the future play and I guess how we get all this stuff delivered. I don't know if you still have cable or not. Or no.
I don't have cable. Right. I'm T-Mus. I got no cable. I got T-Mus, and I'm waiting to get my internet through them as well. All right, coming up, Rajiv.
People reach you.
What? What did you say? He's messing me up. Rajiv Jain will be joining us. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. We are now down to 17 hours of crucial risk trading.
Hours.
Yes, I joke, but
yes,
the options market is pricing in like a 1% move for the S&P tomorrow. You're looking at some moves in the bond market. This could be significant.
No, absolutely here. I just didn't know you started counting at 17. Is there a nice round number we start from, like 12?
Well, in the morning it was like 39, and then 30, I had to subtract 39. And do this.
Were you counting down at 39 early this morning?
Yep,
as well?
got up, logged onto my computer at 6 a.m. and I was already counting the hours.
All right. Well, of course, stick with us. We will have full coverage of that in the morning, of course, followed by the Fed meeting in the afternoon. But at least for right now, traders are kind of left to their own devices, and you're seeing that playing out in the tech space today. Shares of NVIDIA are on the back foot. That's, of course, despite the fact that it's still one of the best performers out there on the year and possibly, quite frankly, over the last couple of years. It is the stock at the center of the AI boom, and it's getting hit just a little bit today on news that the U.S. is weighing more limits on China's access to AI chips. Our next guest has been a big investor in NVIDIA. Rajiv Jain, he's the co-founder over at GQG Partners. His International Opportunities Fund, which is distributed by Goldman, has returned about about 18% so far this year. And overall, his firm has $143 billion in assets under management, including a huge stake in NVIDIA. Rajiv, great to have you here on set. And I was looking at your most recent filings. I know it's kind of backwards looking to the most recent quarter here, but I saw you had a little bit of a shift in what looks like the tech space, kind of exiting some positions, including Alphabet, increasing other positions, entering positions like Supermicro, and of course you've got that huge stake in NVIDIA. What do you like there?
Look, I think the NVIDIA story remains probably one of the best stories in the tech space. Because the underpinnings are strong, they can be demand, and irrespective of what the hyperscalers do, their capex numbers are strong. So one thing which is not fully appreciated, in my opinion, is that the capex to revenue for even a company like Microsoft is continues to creep higher. So all these businesses are becoming more capex heavy or capital intensive, which bodes very well for semiconductor in general. So the shift that you're talking about, in our case, has been cutting back software over the last 6 months towards more semi-type, hardware-type businesses.
And do you think that that is going to be a longer-term
growth
story? So you're not worried at all about the potential cyclical nature of this?
Well, everything is cyclical at the end of the day. So the question is to what level of cyclicality. Yeah. But in a world which is sort of struggling to find growth, look at Europe, look at Asia. I think this still delivers reasonably good growth.
What are the derivative plays of that? I'm thinking power and energy that you need for all of this.
So we like utilities too, U.S. utilities, because they were, they're like 4 or 5 year lows and underpinnings are fine. But I think one of the lessons in the 90s was people always look for alternative to what's the next Microsoft or Intel. Well, the better thing was just buy Microsoft and Intel, rather than looking for derivative of Microsoft and Intel, because there weren't too many.
I don't mean the derivative of NVIDIA. I mean the stuff to support it. Like, do you like utilities
hardware.
Because, okay, hardware.
Hardware, because I think if there's a PC upgrade cycle, the hyperscalers we keep spending, there's a sovereign aspect of AI, data centers, et cetera, that's coming in. You go to Middle East, you go to India, you go to China. So I think that remains out there. And the risk of disruption, or I would say somewhat of an existential risk in software, is going up, which is what the markets are getting nervous about. So which were fairly well known still.
And when you say that existential risk, what's the root
of
that?
The growth rate could slow down dramatically some of the seat-based software companies.
Is that a macro story, or is that specific to industry conditions?
It's more industry condition, not macro.
Okay, so let's talk about the macro a little bit, because there's been a lot of concern about how the economy holds up here in the U.S. and really around the world as well here. I know you're more of a stock picker, you're more of a bottom-up guy, but how does the macro factor in to those decisions right now? Does it give you worry?
I thought you were saying how does Macron fit in, but yes.
Or Macron, either way.
I'm too. Yeah.
So look, I think it's enormously impactful on the bottom-up basis too. So the elections, in some cases, people, I feel rightly so, folks are nervous in Europe, nervous in Mexico, right? I mean, they talk about changing, constitutional changes, which could be pretty significant, and that is one of the most liquid, most widely owned currency and fixed income markets in emerging markets. So we do try to incorporate sort of top down. And I think we just have to be careful about some of the things happening in Europe, because while the estimates are still being revised up, the top down aspects should make anybody nervous in Europe.
Well, I am curious about that. I think that really shocked a lot of people. And of course, we're still waiting to hear from President Emmanuel Macron, not the macro, at some point on Wednesday. If we do, for some reason, see some change in complexion of the European Parliament, and for that matter, the French government as well, does it really change the growth trajectory for Europe?
Okay, so there are two aspects to that. One is the election that just happened. They're not really that meaningful, except they give you a sense of direction of travel for the RN party or Le Pen. However, the growth you talked about, there has been no growth. That is the problem. If you look at between 17 to 20 years in Europe, there has been no growth. And I think that's an aspect which is kind of lost in the discussion, that there has not been growth, and the Ukraine-Russia war has made it worse, because the cost of energy is becoming a huge drag, which is why you're seeing the right-wing parties come back to fore almost every country, because inflation is a real issue.
Which also makes the U.S. situation a bit different. Yes, inflation's an issue for us, but we have the growth in a way that Europe doesn't. But do we learn anything about the elections in Europe and the elections in Mexico and in India in relation to the U.S. elections?
I don't think it really matters in the grand scheme of things in U.S.
Really?
Yeah, because
Why?
I think if you get Trump election, I think it'll be probably be net positive, not net negative, because from a regulation perspective. But I think it tends to move the needle a lot less than in Europe.
But what about changes in regulation, but more importantly, trade barriers?
Well, I think either you have the similar situation or status quo, or it'll improve. In other words, reduce regulations, so on and so forth. U.S.-China relationship, that's a train going in one direction. I don't believe that's changing. Is the speed at which it moves. That's not going to change. The rhetoric sometimes increases or reduces, but the direction is going the same way. The question really is that the growth drivers in U.S. equity markets, they're not going to be impacted by any of this, right? If you look at the tech side or even the large banks, they're doing fine. So I think that would not be impacted as much by the politics of it.
What about the other side of that, of China specifically? Is that still, do you still find opportunity there? Is that investable at this stage? As a foreign investor, that is.
It is investable,
Yeah.
but less so than before. We're concerned about the private sector side, and we have been for some time. We like these state-owned enterprises. But I think China is not going to be the same as it was just a few years ago.
We have to ask you about the Indian elections. That also shocked a lot of folks. I guess, were you surprised that the BJP lost as many seats as they did? And now that Modi at least has maintained his control over the country to a certain extent, but with maybe the potential for having to compromise on things that he didn't have to compromise over the previous 10 years, how much does that change India's trajectory?
Was it a surprise? Yes, it was a surprise. But when we look at the historical context, the number of seats that they got, 240, it is actually a pretty darn good number in a grand scheme of things. The reason being that you're looking at the incumbent running for the third time. I mean, how many times, if you look at UK, for example, last 100 years, how many times have the same individual or party come back into power with thumping majority the third time, irrespective of the economy? I believe it's two times in the last 50 plus years in UK. That's a rare phenomenon. So in that context, it's fine. The other important thing is the partners are supporting him, particularly one of the parties that's supporting him, Chandrababu Naidu. He's very, very pro-growth. So we feel the economic growth agenda does not change one bit. Some of the major big picture reforms might get pushed back, but they don't impact the market as much.
All right, Rajiv, going to leave it there. Rajiv Jain, always great to talk to you. GQG Partners Chairman and CIO. We have some breaking news crossing the wire here. Paramount shares taking a quick drop lower, down about 7%. This on the back of a report that Sherry Redstone and National Amusements have decided to stop talks with Skydance on the acquisition, of course, of what would be Paramount itself here. This was a very complicated deal, Alex, that effectively wasn't just about the Paramount shareholders, but placating Sherry Redstone. Based on a Wall Street Journal story citing people familiar with the situation, Sherry Redstone, at least for right now, has decided, and with her controlling stake, to end talks with Skydance. And
this was as Paramount Special Committee met to vote on that Skydance deal. This would have seen her stake in Paramount sold to David Ellison for about $2.25 billion. And then he and his partners would then pay down some debt for Paramount and then, in essence, buy all of Paramount.
And so all we know that's left out there right now is maybe a potentially Sony Apollo deal, and maybe whatever Edgar Brofman Jr. has been sniffing around for that would actually placate Sherry. But the Skydance deal, which I think most investors seem like they thought was the best deal on the table, I guess for right now, Sherry Redstone saying no. All right, a lot more coming up here. We're going to go out to Las Vegas, Alex, for the Splunk Annual User Conference. We're going to have a sit down with the CEO of Cisco, Chuck Robbins, and Gary Steele, the former CEO over at Splunk, now under the Cisco umbrella. That's coming up next, right here on The Close on Bloomberg. Welcome back. Let's talk about Cisco. It's betting big on Splunk to build its AI portfolio, recently closing the acquisition of the software company and now announcing plans to invest $1 billion in startups working on what it calls secure and reliable AI services. Cisco and Splunk unveiling its latest AI enhancements at its annual user conference in Las Vegas.conf. So let's head out there right now. Chuck Robbins, the chair and CEO of Cisco, joining us right now alongside Gary Steele, now the president of Cisco's go-to-market business. And let's talk about the security aspects of this, because this is really right in your wheelhouse, Chuck. It's right in the wheelhouse of what Splunk does, and it's what every corporate executive right now is talking about when it comes to AI, not just how we profit off this, but how do we keep it safe.
Yeah, first of all, thanks for having us, and you're exactly correct. I think that AI has introduced both a set of increased threats as the bad actors around the world actually utilize AI to create more effective attacks and to create more realistic attacks on our customers. At the same time, we can use AI, and we will increasingly over the coming months, quarters, and years to actually help our customers defend themselves more effectively. And we think if we do it right, we can actually give our customers a hand up against the bad actors as we look to the future. And we think this acquisition was a big aspect of actually helping us do that.
Gary, talk about that here. I know this was probably more momentous for you than maybe it was for Chuck, who's kind of an old hand at this, but you're now under that umbrella here. I mean, Cisco is a behemoth. I mean, the company that you kind of took over there and sort of helped facilitate this deal, that was a big deal. It was a big deal for investors. It's going to be a big deal for clients at Splunk and more importantly, clients at Cisco.
Yeah, absolutely, and super excited to be part of the Cisco team. What I'm most excited about, frankly, is the journey that we've been on, driving amazing innovation and helping our customers leverage AI to have a better security posture. That journey just gets accelerated under Cisco. And so I couldn't be more excited. We've got some great announcements here at our user conference around AI and how we're bringing AI into the hands of the practitioner to make their lives easier and their jobs better. And all of that work that we've been doing really just gets accelerated being part of Cisco.
Hey, Chuck, I'm interested that one criticism about the deal is that it'll be dilutive to Cisco earnings because of the lack of synergies. What, in terms of expense synergies? Why is that?
Well, first of all, we said from the very beginning that this deal was based on revenue synergies and not cost synergies. And when you spend $28 billion, I think you want to be a little careful. We closed this deal probably 6 months earlier than we actually expected to. So we're easing into this. We're actually going to spend the next 12 months really focused on the integration, focused on continuing the innovation that the Splunk team is delivering, that the Cisco team is delivering. We've already announced several integrations. We announced them at RSA. We announced them at Cisco Live last week. We're announcing them at .conf this week. And our view is that we are going to continue to accelerate the value that our customers are going to see from this acquisition. And we think that's more important. There will be cost synergies.
Okay.
We just aren't focused on those in the very near term.
Okay, so you're just not there yet, Chuck. Is that what I'm reading from you?
That's one way of putting it.
Okay, fair enough.
We'll get there. We'll get there.
Well, you'll get there. You're not there yet. Gary, what can you do with Cisco that you couldn't do as a standalone company? What is the opportunity that now the Splunk can be provided?
Yeah, it goes to a few things. One is we get the visibility all the way through the network. So as you think about helping companies improve their security posture, being able to take that network data that's rich to bring into our environments to ultimately identify lateral movement in networks, super critical to help customers protect themselves against threat actors. And more broadly, we think about digital resilience as a critical mission that we've been on. So how do you keep systems up and running from a security perspective and an operational perspective? That end-to-end visibility is something that no other company in the world can deliver. And Splunk plus Cisco is a really unique combination where we can deliver tremendous value to customers as a result.
Chuck, I am curious here about what's next. I mean, we talk about this idea of the integration of Splunk, and I know this is a big deal. It's going to take some time to really integrate it in there. But there's got to be something else on the horizon. Is there anything else that you're considering?
Well, we're continuing to look at anything that can help bring greater value to our customers. I mean, we've had this M&A strategy for years that focused around strategic fit, financial balance, and cultural alignment. And when you find those three things and there's great value that we can deliver for our customers, then we're interested. And you can think about other opportunities in security, although I will say that our internal team at both Cisco and the team at Splunk have been innovating over the last 18 to 24 months at a pace that we hadn't prior. But you think about security, you think about some of the emerging AI stuff that's going on, you think about observability, anything that helps us deliver greater insights from all the data that our customers are trying to navigate would be areas that we would focus on both organically as well as inorganically.
Gentlemen, we have to leave it there. We have some breaking news, but we do appreciate you both taking the time. We'd love to get you back and talk more about how those cost synergies as well as the revenue synergies line up. Chuck Robbins, Gary Steele, thank you both very much. Let's get back to that breaking news on Paramount. Shares quickly falling after reports that Redstone's National Amusements is ending discussions with Skydance. Apparently, Sherry Redstone would like to pursue a sale of just National Amusements and not try to merge it in Paramount into another company. Bloomberg News M&A reporter Michelle Davis joins us now. Paramount shares down over 10%. Michelle, what do we know so far?
So this is a pretty surprising development. The special committee for Paramount was actually just meeting today in the past hour, and they were expected to recommend in favor of the David Ellison deal, which would have seen Paramount merged with Skydance Media, David Ellison's production firm, and then David Ellison buy out NAI, the control of Paramount, from Sherry Redstone. This is a surprise decision. We're still trying to, reports have said that Sherry has decided to sell NAI instead. She doesn't want to merge Paramount with any other business. There are reports that there are two other media moguls interested in buying her stake, and so we'll be staying tuned to see how that turns out.
Just explain this, because it gets very confusing, Michelle. So when you say she doesn't want to merge Paramount with another thing, she just wants to sell off National Amusements, where does Paramount end up in that scenario? I'm just a little confused.
So Sherry Redstone, through National Amusements, owns the voting control of Paramount. She owns 77% of the vote, but only 10% of the economic interest. And so you could technically have control of Paramount and Paramount's decisions by just buying out Sherry Redstone and her controlling shares. But that would give her some continuing say in what happens at Paramount.
So what actually is in National Amusements? Like, what would someone actually be buying?
So it's a chain of movie theaters that Sommer Redstone, Sherry's father, helped build, but also those controlling shares in Paramount. So Paramount has Class A shares and Class B shares. Yeah. The Class A shares, which are the voting shares, are more valuable than the B shares.
All right, another dumb question coming your way, Michelle. I mean, I looked this up. I looked this up for 1,500 movie theaters. I mean, let's face it, the movie theaters aren't necessarily a growth business here. So is the valuation being attached to National Amusements, whatever it is Sherry has in her head there, is that primarily because of the exposure to Paramount?
Yeah, it's primarily what you're paying for in buying National Amusements is control of Paramount more than the movie theaters.
All right. Well, thanks for putting up with my dumb question. This is very confusing. Hopefully Sherry gets her bag, and hopefully Paramount investors get theirs, and we can move on. But for right now, Paramount shares down about 9% here in the cash session. Bloomberg's Michelle Davis here. That's quickly become one of the biggest movers here on the day, Alex, as we move closer to the closing bells. In fact, biggest right now decliner in the S&P.
It's like a Rorschach test. Like, I genuinely don't understand.
I mean, somebody understands it. I guess there's a lawyer or an accountant or a CPA who gets this, but it's just like, let's get on with it already.
Yeah, I totally agree with you. All right, let's get checking in on the markets. You're still looking at a record high for the S&P. The NASDAQ also outperforming. The VIX slightly elevated. How many hours are we down? We're down 16 and a half hours.
I've lost count.
I'm on it. 16 and a half hours until we get to that CPI. And you have financials just continue to get hit there as yields continue to move lower as well. So there you go.
All right. Well, as we count down, I think she said 16 hours into that CPI report and roughly about 22 or so hours before we get to the Fed rate decision. Jay Berry joining us right now, the co-head of U.S. rate strategy over at JPMorgan. All right, just give it to us, Jay. Is this the type of event with the CPI and that Fed meeting that investors want to be out in front of, or do you just sit and wait until we see the numbers and we hear from Jay Powell to talk about reallocating or entering new positions?
I think you're supposed to sit and wait, remain, because it's just fraught with event risk tomorrow. I think on one hand, you've gotten a sense that the inflation numbers the last couple of months haven't been as firm as they were in January and February, and that should be a comfort. But we're still kind of nowhere near the place the Fed needs to be ready to start potentially lowering rates. And we think, if anything, tomorrow's CPI reading is likely to be slightly above consensus. So that could be bearish for the rates market. Mm-hmm. But then contrast that with the afternoon, where I think Chair Powell has adopted chronically dovish tone the last number of meetings, and rates have been declining nearly every FOMC meeting for the last year and a half. Yeah. And I think you just have to sort of pay to see the number tomorrow before you can get ahead to the FOMC meeting in the afternoon.
I got into a spirited debate with somebody about what interest rates we're actually pricing in right now? I'm talking about in the public markets here. Are they pricing in the here and now of what they think is going to happen? Or are they really looking further off into the future and saying rates should be here based on where we think things are going to be in, say, like 2025?
I think the markets are pricing in called 125 basis points of cuts over the next year and a half or so, which to me says it's in the here and now, an economy which is decelerating, but really doesn't have any vulnerabilities that we can find. And inflation's moderating, but not back to 2%. So I think it's very much in the here and now, but it's been a pendulum swinging back and forth. I think a month and a half ago, everyone was really focused on how the durability of this expansion was sort of really leading, and it was hard to find any weakness. And then very briefly in the month of May, the way the data decelerated, everyone was looking for the next shoe to drop with the labor markets. And now we're somewhere in between because it's kind of been between both ends of the pendulum right there.
What did you make of the strong demand today at the 10-year?
So I think it's a bit surprising to me because frankly, Alex, 10-year auctions, the proximity to CPI really matters. And the closer you are, the weaker they tend to go. So this sort of bucked the trend. And I think what it means is investors have looked ahead to tomorrow. They have seen that over the last 2.5 years, it's much more likely that Treasury yields decline on FOMC day than they do rise. So feel like with rates having backed up now about 15 basis points over the course of the last 3 or 4 days, that this is an opportunity to add ahead of tomorrow with a little bit of a less concern over the CPI reading.
How much do you think of, though, is safe haven buying after what we saw over in Europe at the ECB and then also the elections?
I mean, I think we priced that in briefly this morning, the way yields were lower across the curve, but the way we sort of rose throughout the day, it seemed like we were making room for this auction, and the focus turned more squarely to the domestic events than to the fallout from what happened with the European elections over the course of the weekend.
What do you make of that move that we've seen in spreads over there? And I know it could potentially get worse based on whatever Macron says tomorrow.
So to us, it seems like it's a repricing for a higher likelihood that he will lose his majority in the lower house now that he's called the snap elections. If anything, I think our colleagues in Europe believe that we're priced for some sort of Le Pen majority outcome. But also, I think what you've seen here is, and this has been everywhere, whether it's in the US or Europe or Canada, everyone's been in sort of income earning, carry seeking mode because we're at a point where inflation's decelerating, but yield curves are inverted. And in Europe, being overweight semi-core and peripheral names was a way of earning carry. So I think people have been taken out of those trades as well.
And the carry trade, is that going to run its course? So, because I mean, some of that has been fueled by the lack of volatility, but then everybody's saying, wait, the volatility is about to show up pretty soon.
I mean, I think it's still there because if we're in a very range-bound rates trading market, you're supposed to be focused on income. But I think you just need to understand that on a risk-adjusted basis, it's come down quite a bit. And that, to your point, Romain, it's very directional with volatility. So you have to be convinced that volatility is going to continue to move lower from here.
All right, Jay. Always great stuff with you. Did you see our new set that we got here? We did this just for you, by the way.
It's nice and bright.
All right. Don't forget to get your swag bag on the way out. Jake Berry, co-head of U.S. Rate Strategy over at JPMorgan, helping us count down to the closing bells. Alex, we're about 3 minutes away from those closing bells. I forgot how many hours away from the CPI.
I can't do math, but 16 and a half.
You got to give me. I want the minutes and the seconds in there.
It's totally my bad.
What do you make though of the price action? Because right now, it's basically, if Apple wasn't on this like record run today, I think the S&P would be in the red and the NASDAQ would basically be flat.
Yeah, so I was thinking in the early top of the show, it was like Apple versus banks. Like Apple is what's holding everything up, and then banks is what's really dragging everything down. Options are showing that we're going to move 1% tomorrow in either direction. So, but we're at a record high. So is that just increase to the downside? Like, what would justify a move 1% higher at this point?
It's so hard to get a read on that, right? Because I feel like, I don't know, I feel like if we had this conversation 2 years ago, I can give you a more definitive answer, but I don't know.
Yeah.
I mean, I just don't. I mean, I feel like if I make a bet on something, could be the complete opposite based on the way people are feeling.
And we have seen a lot of money come into U.S. stocks. Bank of America had that survey out that showed that U.S. equities came in for the first time in 6 weeks. So are we overdone at this point?
All right. Well, we are getting closer to those closing bells. Our full market coverage starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romain Bostic alongside Alex Steele. We're here to help take us through the closing bell. It's a global simulcast, or something of that nature. We're joined right now by Scarlett Fu in the TV studio, Carol Masser and Tim Stenovic bringing it up in the radio booth as we welcome our audiences across all of our platforms here. A pretty interesting day ahead of what could potentially be a much more consequential day tomorrow, Carol.
Yeah, and I think that, the Fed is going to be dealing with a lot of conflicting signals. If you look at some of the data points, just the labor market, we have conflicting signals. Having said that, I'm just trying to make sense of what's going on in banks today because the KBW Bank Index is down a lot. It's down, as I pull it up, about 2%. here in the trade, and you've got almost every name showing some declines. And I'm not quite sure, just talking with our Bill Maloney, trying to make some sense of exactly why we're seeing some pressure in the banking sector.
I guess you could say they're down ahead of tomorrow's Fed meeting.
But why?
We don't know. I don't know, Alex, if you're seeing any reason why they're lower, but certainly the worst performing sector in the S&P 500 today, JPMorgan, we see Bank of America, Citi, PNC, all lower on the day today.
Yeah, Capital One losing more than 4%, State Street also losing 4%. You know, there used to be something called a Fed drift where stocks would rise during the week of FOMC meetings. This is according to Nick Colas of DataTrek, and there was actually a white paper published on this. That happened pretty reliably from 1994 to 2011, but in the past 1.5 years, the drift has largely disappeared. And, you know, you're not seeing much of a rally in the Tuesday to through Thursday period. You only get a gain 45% of the time. So, you know, there's no more lift due to the Fed.
And definitely not in banks. So, Tim, you were asking sort of why? Well, I don't know. I mean, yields are lower. Huntington didn't do well yesterday, lowering its guidance for the year. We're continuing to be worried about central commercial real estate. You take a pick.
All right, we get the closing bells here in New York. A Dow Jones Industrial Average never really gaining any traction on the day, lower by more than 100 points or about 0.3%. The S&P and the Nasdaq both in the green. You can thank Apple largely for that, particularly for the S&P 500, a 15-point gain on the day, and all of that right now attributable to Apple. 0.3% higher for the S&P, 0.9% higher on the Nasdaq Composite, 0.7% higher on the Nasdaq 100, and your laggard on the day, that is the Russell 2000, lower by roughly 0.4%.
All right, quick check on the S&P 500 to follow off of those closing numbers from Romaine. And you're looking at most names in the S&P, 322 to the downside in the Tuesday trade. Scarlett, you got about 179 gaining ground and 2 unchanged.
And if you look at the sector performances, we only have 2 gainers right now. Tech, and that is largely on the back of Apple. Communication services, Meta, Netflix gaining a little bit here, but REITs have turned negative. And all the other sectors are in the red. Financials, utilities, and industrials lead the way down.
Yeah, a lot of red there. That was not the case, though, for Apple, which didn't do so well yesterday following its big event out there on the West Coast, which, of course, continues throughout the week. But it feels like all of a sudden investors are like, oh, yeah, get it. AI, Apple Intelligence, we get it all. And so we did see this stock pretty much hold on to all of the day's gains. It's finishing with about a 7.3% gain. It was the number one gainer in the S&P 500 and the NASDAQ 100 today. Apple shares hitting a record. So, again, AI for the rest of us. Apparently, investors liked it, and they were piling into that name. We talked about banks being under pressure, but Affirm Holdings actually having a very bullish day, finishing near its highs of the session, up about 11%. You know it, the buy now, pay later company, rising on heavier than normal value. The company said Apple announced that Affirm's payment products are expected to be available to Apple Pay users in the United States later this year. So you had investors moving into that one. And here, something a little bit different. Calivo Growers, CVGW is the ticker, was up 22% at its highs. It's a small market cap, about $474 million, finishing the day with about an 8% gain. It distributes avocados and other produce, posted second quarter profit and sales that topped analysts. I should point out that about 6% of the float is shorted. Stock is still down about 9% year to date, but I don't know. I just thought it was kind of interesting, something different.
I think it's because of all the avocados we're eating in the Stenevec household.
I just want to point out, too, just before you move on,
Sure.
we are awaiting earnings today out of Oracle. We're getting some insight here into their next move here. The headline crossing the Bloomberg terminal right now, Tim, is that Oracle and Google Cloud reporting a multi-cloud partnership. I don't know what that means, but investors seem to like it.
Oh, there we go. Actually, OpenAI is selecting Oracle Cloud Infrastructure. That's going to be that partnership. So OpenAI selects Oracle Cloud to extend the Microsoft Azure platform. Interesting stuff as we wait for those earnings.
Especially given yesterday's news about Apple and the OpenAI partnership, it seems like a real winner in all of these new partnerships is the one common denominator, OpenAI and Sam Altman. So certainly we'll keep an eye on that. Oracle shares are rising 4% post-market after this announcement. Hey, I do want to get to some decliners before we do get more earnings that we await. Tesla finishing the day down by 1.8%. JPMorgan analysts led by Ryan Brinkman came out with a report that said that even though Tesla will show a robotaxi concept and maybe an accompanying app on August 8th, material revenue generation is unlikely for years to come. Also, shares of JPMorgan Chase falling today. Financial is the worst performer. We've been talking about this throughout the program. Banks in the S&P 500 down more than 2%. JPMorgan, Bank of America, Citi, PNC. This ahead of tomorrow's Fed meeting. Shares of JPMorgan down 2.5%. And Paramount Global shares falling late in the session, just plummeting after the Wall Street Journal reported that Sherry Redstone's National Amusements has decided to stop talks with Skydance. We saw shares fall double digits just in the minutes leading up to the close after the Wall Street Journal reported this, finishing the day down, though, by about 7.9%.
You know, I think, Alex, I'm just going to make a bid here. Why not, right?
Everybody
I don't
else
think she's going to like your bid, man.
I don't,
mean,
but
I
what's
don't think she likes any bid. A lot of billions, come on.
What do you, I mean, what are the assets you're interested in?
Oh, man? You don't want to see my assets, man.
No. What you're interested in, not what you have. Hey, look into the bond market for a second.
MTV, VH1,
Alex, you're pivoting
Comedy
from
Central.
I'm pivoting before we get to Oracle
Okay.
because I feel like we're into the Fed, we're into CPI. I have a countdown clock. I have 16 and a half hours until we get that CPI. You had strong buying pretty much across the curve. You have yields lower. It was there in the morning, and the bid came in even more so at 1 o'clock after you got a 10-year auction. That went really well, as Jay Perry was just telling us. That's unusual into a CPI Fed meeting.
All right, everybody. As we said, we've been watching Oracle shares and, again, continuing to see this one moving higher in the aftermarket, still up about 3.5%. We talked a little bit about this company talking about selecting Oracle Cloud, OpenAI selecting Oracle Cloud to extend its partnership. And now we have Oracle earnings coming out. So Oracle just breaking as we are talking.
All right, let's take a look at the numbers here. Fourth quarter adjusted revenue, $14.3 billion. That is lighter than what analysts had been looking for. They had anticipated revenue of $14.57 billion. In terms of adjusted operating income, $6.67 billion by that metric, slightly better than what had been anticipated. You distill that into the EPS, adjusted EPS of $1.63, trailing the consensus estimate of $1.65. The operating margin for the fourth quarter, 47%. Analysts were looking for 45.5%. So that gain that we saw on the headline about Oracle and Google Cloud partnership, that has now faded, and the stock is down about 1.5% right now.
And looking at some of the segment growth, or rather lack thereof here, a drop in the services revenue down 6%, a drop in hardware revenue down 1% here. And then even when you look at the cloud license and that on-premises license revenue, that was down 15%. Now, I guess the good news is their biggest business, which of course cloud services, that was up 9.2% here. But kind of interesting to see that as they try to transition more to cloud services here, they still are getting some drag here from those legacy businesses.
Safra Catz coming out, the company's CEO, and saying that in the third and fourth quarters, the company signed the largest sales contracts in the history of the company, driven by enormous demand for training AI large language models in Oracle Cloud. And then Oracle chairman and CTO Larry Ellison saying that they've agreed to work together to support OpenAI and ChatGPT, and 11 of the 23 OCI data centers we're building inside Azure went live in the quarter, talking about the multi-cloud cooperation with Microsoft that expanded significantly in the fourth quarter of the year.
Yeah, just to go back to some of the breakdown there, the fourth quarter cloud infrastructure revenue, that was sort of the one everyone was watching, came in at $2 billion. That is a little better than estimated, up 42% in dollar and constant currency. But the question is, is there a demand issue or is there a supply issue, and how is the company managing that? And as Romain mentioned, sort of the old legacy businesses potentially not living up on that. Also, just to point out, cloud application came in about $3.3 billion, and the overall cloud revenue was at $5.3 billion.
All right, stock's still up about 5% there in the aftermarket, and this the stock is up about 70.5% here in 2024, so building certainly on the year gains. All right, that's a wrap, guys. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. The closing bell. We'll see you again, same time, same place tomorrow.
All right, our coverage continues here on Bloomberg Television, a deeper dive into those earnings that we just got out of Oracle. Abigail Doolittle joining us right now for a little bit more here. We saw the numbers, Abigail, here. It looks like a little bit of a miss here on some of the guidance that they're giving. But overall, this wasn't a bad quarter. But, we kind of have this yin and yang between those legacy businesses that were kind of the hallmark of the last big tech boom and this transition that Oracle's been trying to make to the cloud and the future.
Yes, absolutely. And I think that investors are still sorting through numbers. But right now up 4% after having initially been higher on the announcement between Oracle and Google for a cloud partnership, then down, now up. So I think we could see a little bit of that back and forth. But to your point, in terms of the different businesses, it's all about going toward the cloud. Alex was saying that they did beat the infrastructure number just a little bit up, just a little bit better growth of 42%. But what's interesting, that growth is actually down from the average of the previous 2 quarters of closer to 50%. So some of that may have to do with AI capacity constraints, that is behind that decline to some degree. Now, relative to the legacy software that you're talking about, yes, that needs to be worked through. And I'm also looking here through the details to see whether or not there's any indication of whether they've completely worked through Cerner, because that, of course, that acquisition that they made for that healthcare software, they've had a hard time integrating it, lots of delays there, and that's been a bit of a drag. This stock has really been stuck in a very big range for more than a year.
Yeah, I'm really glad you bring up the Cerner part of it, because it's something that's been a little bit of a stain on Oracle stock.
Yes.
In terms of how much the company really wants to address this, is the worst over here for when it comes to Cerner and Oracle?
We don't quite know yet. I'm looking through the headlines. I don't see anything addressing it specifically here. So that might be something. It will certainly be something on the call that analysts will be nailing them on to get more information on whether they have actually gotten that put into place. But the stock, wow, now really at post-market highs. The stock had been down in the session, but it's up about 6.3%. So it suggests that, and I'm trying to look through these headlines right here to see if there's anything new that's come out that's investors are trading off of. But there is something I would suspect new that investors are seeing, that they've just taken up another 2 or 3%.
All right. Well, Oracle shares higher by about 7% here in after hours trade. Another stock moving both in the cash session and after hours is Paramount, and that is to the downside. The Wall Street Journal just reporting a little while ago that Sherry Redstone's National Amusements Company has decided to stop talks with Skydance. Joining us right now is Bloomberg's Hannah Miller for more details here on what we know and maybe what could potentially happen. Hannah, this is a kind of a long-running saga that I think a lot of us want to see end here. What exactly is the next step here? What does Sherry Redstone really want? Is it maintaining some control of Paramount while at the same time getting whatever cash she can for National Amusements overall?
I think the path here is that Redstone is going to pursue a sale of National Amusements. You know, we know she wants out. And, you know, that equity drop of NAI, that was really a factor here in these talks ending, you know, that have been reported.
So, quick question here then on who's left. Who else is bidding for this company, or at least which bids is the Redstone family seriously considering?
Yeah, we've seen a lot of bids here. You know, this has been an ongoing thing, very drawn out. And it's been, you know, interesting to see which have been taken seriously, which haven't. And for sure, the Skydance deal was the leading contender. So it is pretty shocking here that this is no longer on the table.
Okay, it's no longer on the table. We know she wants to get out of this, but is there a timeline in terms of how quickly she needs to be out of this? Or can this drag on for another couple months, maybe even a year?
Yeah, so going forward, you know, the special committee thinks that Paramount is not really a viable company without a deal. There is a time pressure here, so we could see things wrap up quickly. We could see a sale of NAI soon.
Give us a sense here. I mean, there's no real deadline here, right? This is basically just kind of on the whims of what Redstone and the board over at National Amusements want to do.
Yeah, I mean, you know, these are all factors, but it all comes down to what Redstone wants. You know, she's the controlling shareholder, and, you know, it'll be interesting to see what plays out here.
All right, Hannah Miller there, who helps lead our entertainment coverage out there on the West Coast. The headline, this on Paramount: Redstone, Sherry Redstone, ending discussions with Skydance Media over a merger here that would effectively have splintered off Paramount. All right, we're going to try to get you some more details on that, but we want to make a pivot here to what's been going on in the travel space here. Whether you were talking about cinema or cruises, higher for longer interest rates continue to play a key role for cruise operators that have been riding the wave of the post-pandemic travel surge. But that momentum showing some signs of a slowdown compared to the S&P 500. Let's get some insights here from somebody who knows this better than anyone. Harry Sommer, President and CEO of Norwegian Cruise Line, joining us right now. And Harry, there's been so much talk here about the bump that we've seen in this industry, the bump that we've seen out of Norwegian specifically here. Is there any sense here that that's fading?
No. Well, first of all, thanks for having me on. No, we do not see any fading. Consumer demand continues to be very, very robust. When we reported our Q1 earnings and reiterated it again in our Investor Day last month, we see demand at all-time highs, occupancy at all-time high, future book positions at all-time high, all on higher pricing. We are very, very encouraged by the American consumer.
When we look at the American consumer and we look at their sensitivity to prices and inflation and the like here, how sticky do you feel the cruise line business is? I mean, there's always been these anecdotes that the people who love cruises will always cruise no matter the economic conditions. Is that really true?
So certainly, listen, there are two different sets of people. There are people that are historic cruisers, that are avid cruisers, and absolutely we see them coming back. Our repeat rate is at or near high levels compared to where we were on a pre-COVID basis. But at the same time, we are attracting a record number of new to cruise as well, especially in the younger demographics, which are our fastest growing segments. Cruising at some point been associated with a slightly older clientele, and now we're seeing younger people in their 30s and 40s coming to cruising in record numbers also, which we're very pleased with.
Okay, so that's really interesting, the breakdown of your demographic. When we look at the American consumer and demand from them, there is a perception among investors that the more indebted cruise lines, and I look at your debt to asset ratio, it is higher than your peers. They are a levered consumer discretionary name, and that makes you more vulnerable to any weakness in middle class spending. Is that view wrong?
I'm not necessarily sure if that view is wrong, but you have to sort of think about who our demographic is as well. Within our portfolio, we have three brands: Norwegian Cruise Line, which is one of the more higher end consumer brands. And then we have an Oceanic Cruise brand, which is more of an upper premium brand. And then Regent 7 Sea Cruises, which is a luxury brand. And across our portfolio, in their respective segments, they are the highest priced and therefore attract the highest quality demographic customer. We are not looking at low-end consumers. We're looking at high middle-class, lower upper-class consumers that seem to be doing very, very well in the current consumer market. But there's a second piece to it that I'd also point out, in that the value proposition between us and a hotel vacation has never been higher. The typical cruise ADR, average yield per night, is about 30 to 40% less than an equivalent hotel vacation, despite the fact that cruises offer more. We're not just transportation and hospitality. We also have meals, entertainment, and other onboard amenities. So good value, upper consumer demographic, and good value versus the hotel industry all point us in the right direction.
Right, and they're definitely a group of investors who like that story, who buy that thesis, and are bullish on cruise line operators. Yet, when I look at your stock over the past 12 months, up about 2% versus up 25% for Carnival and 68% for Royal Caribbean, what do you attribute that difference to? Why the underperformance?
I think about a year ago, we had slightly higher aspirations for 2023 that we were able to achieve. And that caused a little bit of disappointment in the financial community. But I think at this point, we have to sort of put that behind us and focus on for 2024. Since coming out with our initial guidance for 24, we've now raised it twice, just a few weeks apart from each other, because our top line revenue number continues to overachieve our expectation and Wall Street consensus. So I agree we might have gotten a little bit ahead of our skis in 23, which didn't do well for our stock in the back half of last year. But now coming into this year, we are absolutely seeing a rebound off of that. Our stock's up 8% in the last month, which we're very, very happy with. About a month ago, we discussed our long-term goals on our Investor Day for 25 and 26, which seems to be resonating very well in the market as well.
All right, good stuff. Harry, really appreciate your joining us today. Harry Sommer is president and CEO of Norwegian Cruise Line. When was the last time you've been on a cruise?
Never.
You've never been on a cruise?
I've never been on a cruise.
Your family didn't drag you on one?
I have family members that are diehard cruisers. I have yet to sort of make that leap. I don't know. I just being stuck on a boat with a bunch of random people.
I mean, that's why you're with your family. You guys all wear the same T-shirts, that announces to everyone that the Bostic family is here.
The same T-shirts? Oh, yeah.
Yes.
I look like a same T-shirt kind of guy.
Well, that wouldn't be your decision to make. It'd be some others.
Are you a cruiser?
No.
No.
Yeah, for the same reason we're not into the
Yeah,
t-shirts.
but people love it. They love it. And, I remember that when the pandemic shut everything down, and I had folks in my family, as soon as they lifted those pandemic restrictions, it was like the next day they were buying tickets.
With t-shirts and sweatshirts.
Yeah.
All right, coming up, we're going to get insight on the growth of private assets and some potential cracks that may be developing. Our guest is Marc Lipschultz. He is co-CEO of Blue Owl Capital. This is Bloomberg. Let's turn our attention now to private markets and the cracks that are starting to surface. Apollo Global Management's Scott Kleinman provided a reality check last week at the Super Return Conference in Berlin, saying, "I'm here to tell you everything is not going to be okay. The types of PE returns enjoyed for many years up to 2022, you're not going to see that." For more insight, let's bring in Marc Lipschultz. He is co-CEO of Blue Owl Capital, which has $174 billion in assets under management. Marc, really great to speak with you. Thank you for joining us today. It's been, 2+ years since rates began climbing higher and higher for longer. It's clearly the new normal, and that means some companies are having problems servicing their debt. PE firms and their lenders are getting more, let's say, creative in ensuring that debts get paid to avoid default. I'm wondering from you, are things getting too complex to the point where maybe some problems are being swept under the rug?
Higher for longer, and some of those challenges you described for the equity holders are realities. But that's exactly why we love the senior lending business, to be perfectly candid. This is a really great time in private credit. I know there have been some efforts by, I might call our antagonists, to paint the picture, picking little anecdotes here and there. But the reality is that we have not seen an uptick in defaults. We have not seen an uptick in companies having trouble performing, and I think that's by virtue of making really good credit selections and low loan-to-value investments.
But others might say that, unlike the public market, you don't have a Fitch or a Moody's saying that this is a default on the debt the way that they would for something that's traded on the public markets.
Well, a default would be a default in any market. You're right. We don't have the opinion of the credit lending agencies on the business. I would proffer that's one of the great advantages of our model for the user of capital. Listen, at the end of the day, as opposed to a third party, and no offense to Fitch or Moody's, they do a wonderful, wonderful job for what they're designed to do. But we're designed to provide long-term capital and make a very in-depth decision around those companies, counting on the long-term strategy to get paid back, and it works. We've done about $100 billion in loans, and our running loss rate has been 7 basis points. And so there's something quite substantial about the ability, like a long-term investor in equity, to take a long-term view of the credit, not what happened this week or this quarter, but are we going to get paid back? And the terrific news about our business is we consistently get paid back.
And Marc, though, but you do know, there is a timing for investors, that is. There is a timing issue that some of them do have to be mindful of, particularly when they need the cash for other things here. And there's been a lot of concern here that, at least coming off of those last vintages, some folks aren't getting the payouts in the time frame that maybe they had anticipated here. What do you say to those people? What do you do to actually placate them?
It's a great question, and Romain, good to see you again since our time in Milken together. It is, I think, a really great point. It says pick your manager wisely, understand their strategy, understand what you're investing for and in what structure. We've designed our firm from day one in credit to be able to serve institutions, CalPERS, CalSTRS, and individuals as true peers. They have different uses for liquidity, different needs. And so you have to be very aware, I think, of what you're investing in and what product, what structure. Our products deliver quarterly, or in some cases monthly income, and we've been doing that in the 10 to 12% range in many instances per quarter. So people are getting a lot of capital. If they want to be in a structure where they can get their capital back, again, pay attention to the manager, pay attention to the structure. We've been able to, every time someone's asked us for capital back in our continuously offered credit products, they've got it back.
With regards to deals being done here, there's been a lot of talk about how margins have gotten a little bit tighter here. Have you seen that?
Yeah, we've seen margins rise to sort of a peak in 2022, 2023. when I think a lot of the world was feeling more uncertain about the economy and this trajectory of rates that talked about moments ago. And we saw spreads widen. We've seen those spreads, contract back to probably where they were in 2021, maybe even a little tighter than that, all things equal. But to us, the key is high quality credits. The key is, are we lending to great companies and doing that at low loan to value? And then are we getting an attractive return for it? And at today's spreads with today's base rates, that still produces a double-digit gross return. So absolutely, spreads have come back from their peaks, but they're still in a very attractive place for us as an investor.
We talked about how private equity, it's kind of a crunch time for them. They're seeing less demand, but private credit has a lot of money to work with. There's a lot of dry powder, and that has led private credit to become more competitive on pricing, on covenants. Some might even call it a race to the bottom on terms. What are you seeing?
Well, I'm thankful we're not in that race, but it may very well be going on in parts of the market. For us, it's about delivering a value proposition to the user of capital and having partners who are willing to pay fairly for that. And look, sometimes we get paid more, sometimes we get paid a little less, but on average, we're lending through less than 40% of the value of an enterprise and earning a double-digit unlevered return in today's environment with today's spreads. I would suggest that feels really, really good, especially if you're thinking the world feels a little more uncertain than maybe it did 6 months, a year ago. With all that said, for PE, look, I love the PE business side. My origins in the PE business, and those are our clients and our partners. But there's no doubt a different challenge when we're the top third, 40% of the capital stack. They're the bottom 60+% of the capital stack, trying to earn a return. I imagine they hope to earn a return at least as good as ours. But which of those might you pick today? A great PE manager will do a great job, but I think private credit in the right hands is the steady as you go solution, and that's our job, picks and shovels to that gold mining industry.
All right, Marc, really appreciate your joining us today. Marc Lipschultz is co-CEO of Blue Owl Capital, which of course is publicly traded, did close up about 3 cents today to $17.41. I was really surprised to hear Scott Kleinman make those remarks about PE.
Yeah, and we've seen a lot. Marc started off talking about all the antagonists. I don't know if he was referring to Bloomberg, because we've been writing a lot of stories about some of the issues that the private capital space is going through here. But legitimate concerns, whether that actually drives away investors or not, we're going to have to wait to see.
All right, coming up next, we're going to stay on private markets and talk regulation with Deval Patrick, the former Massachusetts governor. He is currently the senior advisor at the Vistria Group. This is The Close on Bloomberg.
We return to our coverage of private markets and a look at the issue of regulation and using private markets for public good. Joining us right now is Deval Patrick. He's the former governor of Massachusetts and now a senior advisor at the private investment firm, the Vistria Group. He's also co-director of the Center for Public Leadership at the Harvard Kennedy School. Deval, great to have you here. And I want to kind of pick up. Absolutely. I want to kind of pick up where we left off with our last guest, Marc Lipschultz, of course, a pioneer in the private credit space. You have a long history in the investment space, particularly on the private equity side, and now, of course, in your role at the Vistria Group here. How is business right now?
Business is good. We are facing some of the same challenges everyone else is. But because we take a view of long-term value, which is, how do you build an economy, company by company, that is good, not just for shareholders, as important as that is, but also for employees, for members of the community, for the environment. And I think that shift in thinking about capitalism as being more inclusive is exactly what the Vistria Group is about, and frankly, where lots of our trends are pointing. So from that perspective, I think our prospects are very, very good.
Well, can you give us some specific examples of potential investment opportunities with the idea of inclusive capitalism, the idea of making an impact? Because I'm sure, as you know, Deval, and we've come a long way over the last 4 years where everybody seemed to be talking about a reimagining of capitalism to today, where we have this huge pushback where now everyone just wants to keep their head down and not say anything.
Well, I don't know how huge it is. It may be a few leaders who are trying to keep their heads down, but it takes some courage, really, to lead us to the next place. And frankly, there are a lot of secular trends, especially from young people, who are insisting that capitalism cannot be just about a few winners and everyone else being losers, that we have to have a way of thinking about value that includes the interests of all of those affected. And frankly, what we have seen in our own investment here is that there's a premium to be harvested for everybody. So we're investing in some sectors that are inherently impactful. That is healthcare, for example, knowledge and learning, or education generally, financial services, the kinds of things that are fundamental for people being able to lift themselves and their families into the middle class and to sustain themselves there. And we are measuring both the financial return and the ways in which we can drive that, and the very much connected social or environmental impact. And we've been able to deliver both superior returns and measurable, meaningful, and lasting impact. I think that's exactly what capitalism ought to be and can be.
At the same time, healthcare plus private equity have equaled a lot of negative headlines in recent years, and we've been
following that.
Yeah, and we've seen regulators take a closer look into this sector and the involvement of private equity firms. What kind of level of scrutiny? What's your sense of regulators devoting resources into looking into private markets and their investments in this space, since this is a space you're pretty active in?
So, Scarlett, the first thing I want to say is I want to acknowledge that the regulators and others who are policymakers have reason to be concerned about what's going on in healthcare. Not all of that is attributable to or because of private equity. We have a really fractured, overly complicated healthcare system that is often about sick care and not healthcare. So I want to make that point, first of all. Secondly, I think there are a number of proposals we've seen out there, including ones from the federal government on a set of principles around healthcare, private equity, and its involvement in healthcare that, frankly, we've been doing already and seem to make sense to us. We're taking a closer look at them. We're scrutinizing those and other proposals against our own set of our own playbook, if you will, with respect to how we invest and why we invest and what our expectations are of the companies that we invest in terms of building them from where they are today to where they need to be. But that is what inclusive capitalism is or ought to be about. I think the best and most effective regulation is not no regulation. It is regulation that is working alongside those of us who are trying to do the right thing and those who are affected by what we're trying to do to make sure we get things in the right balance.
Deval, given all that you said, and I don't mean to put you on the spot here, but I do want to get your thoughts on the passing recently of someone that I know you were close to and that a lot of us really followed in this space, and that's the passing of Christopher Edley. I mean, he really sort of espoused for years, for decades really, the idea of how to create a more inclusive economy, a more inclusive society here. And I kind of wonder, and forgive me if this is a wrong question, but where are those thought leaders today? Where is that leadership today coming from to sort of push us forward?
First of all, Chris was a teacher and a friend and a colleague of mine, and my heart goes out to his family and to his professional family, which is huge, because we're all feeling that loss. He believed, as I do, that we oughtn't have, we should be thinking about how to improve our society from the perspective of one sector alone, right? It's not going to be government alone that solves the big challenges that face humankind. And I say that as someone who was a policymaker and believes in the role of government. It's not going to be the not-for-profit sector alone. It's going to take all of us, including the business and commercial sector. And so taking that broader view about how we include and are conscious of and manage around all of the interests that are affected by business and by our commercial interests is critical. And it is how we will actually solve problems. It's been a false choice for a long time that you had to trade return for impact, that business could just do what it did and only should do what it did to deliver financial return for owners, and the consequences of that would fall on government or the not-for-profit sector. By the way, all of which we all also pay for. Today, the scope and scale of our challenges is such that it's going to take all sectors pulling in the same direction. And that's what inclusive capitalism is about. Chris was right about it in his time. I think there are many, many of us, including the as yet undiscovered young people who have been forcing these questions, sometimes in very different language, that we have to learn to listen to as well.
All right, Deval, we really appreciate your joining us today. Deval Patrick is the former governor of Massachusetts, and of course, he is the current co-director of the Harvard Kennedy School of Center for Public Leadership and the senior advisor of the Vistria Group. We want to break some news here for you. There's a headline here about Elon Musk dropping his lawsuit accusing OpenAI of breaching its funding mission. Musk has withdrawn this lawsuit as OpenAI asks a California judge to dismiss the case. So this is one of many headlines that Elon Musk has made recently, Romain, when it comes to OpenAI, because he was also talking about banning Apple devices if they integrate OpenAI at the operating system level.
Yeah, I'm not sure where this lawsuit was ever going, but I guess obviously he's found his own AI ambitions here with XAI or whatever it's called here. So maybe it's just time to move on.
You know, he's got a busy week today, this week.
He's got, he's got a lot of companies he's running.
Yeah, and he also has to sort out his whole pay at Tesla, so that's a different story.
Oh, yeah.
Right? Okay, let's move on here, because when it comes to political headlines, we were just talking with Deval Patrick. Of course, we have to pay attention to what's been going on with Hunter Biden. He's been found guilty of gun charges by a federal court jury in Delaware. The president says in a statement he will continue to respect the judicial process as his son considers an appeal. Let's bring in now Bloomberg's Joe Mathieu for more. Joe, this kind of complicates the president's re-election campaign, doesn't it?
You could say that, but it's kind of a dotted line at best. I mean, there are a lot of questions about the extent to which Donald Trump's 34 guilty counts would weigh on his presidential campaign, and Hunter Biden's not running for president. So it's been an interesting reaction, to be honest with you, in the political sphere, in the public square, since this took place. Even Donald Trump went out of his way to say this trial has been nothing more than a distraction from, as he puts it, the real crimes of the Biden crime family. He's not here to compliment the Bidens, but this trial he looked at a bit differently, referring to his own brother's struggles with alcoholism in an interview last evening. The fact of the matter is, we've been hearing a lot of empathy for the Biden family, which we know went through a lot in the course of this trial. We've even heard from Second Amendment activists who are pointing to the need for what they believe is reform here when it comes to rules involving gun ownership. So, this could be a wash on the campaign. I will point you to the fact that he's got another trial on tax evasion coming up in the fall. It'll be a lot closer to the election and will probably resonate a lot more with people who think about potentially Joe Biden being involved in some business dealings with his son.
Is there any sense that that trial will start and end prior to the election?
There is indeed. We're talking about tax evasion of up to $1 million here, Romain. I talked to a number of pretty smart legal minds today on Bloomberg TV and radio, including Nick Ackerman, the former Watergate prosecutor. They all suggested Hunter Biden should plead guilty in that case for more favorable treatment.
All right, Joe Mathieu there, of course. He is the co-host of Balance of Power alongside Kaylee Lines. For all your political coverage, you want to stick around after the close wraps up, where Balance of Power will take over at the top of the hour right here on Bloomberg. Meanwhile, we do want to get back to some breaking news here, Scarlett, and that is on Elon Musk dropping his lawsuit against OpenAI. Basically, he had accused OpenAI of breaching its founding mission. Now, remember, Elon Musk, of course, was one of the early investors in this company. He pulled out quite some time ago and now has his own AI ambitions with his own firm. We last know that he had raised roughly about $6 billion or so for his own AI venture. Rachel Metz joining us right now to talk a little bit more about this. And Rachel, maybe you can give us some more details, kind of set the scene as to how he got there. Why did he sue originally?
So as you mentioned, Elon Musk has said that the company had breached its founding mission. Basically, what he was saying in the lawsuit was that the company was meant to be more open and more benefiting humanity than it is at this point in time. And the company argued that it didn't have a founding mission that was exactly what Musk was saying that it was. And so the two sides were butting heads and had some back and forth in court filings until he dropped this suit.
So did anything change as a result of Elon Musk's suit? I mean, I know that OpenAI has asked a California judge to dismiss the case, but was this impactful in any way?
At this point, it doesn't appear that the company changed anything. It is not yet clear why he decided to drop the suit. There was a conference between the two sides that was scheduled to take place tomorrow. So the timing of this makes it sound like maybe it felt like a good time based on whatever discussions they were having. I have reached out to OpenAI, but haven't yet heard back if the company has anything to say.
All right, Rachel, thank you so much for giving us the latest update here on Elon Musk dropping his lawsuit accusing OpenAI of breaching its founding mission. We'll keep you posted as we get further developments. In the meantime, when you look at equities and Romain, I look at a chart of the S&P 500. It was pretty much a steady line up as we head into the Fed decision tomorrow afternoon.
Yeah, it's kind of interesting, although we should thank Apple for that, really. Because
yes.
Without Apple, I think we would have seen a little bit more red. But you saw the difference there, right? Just those two lines in your screen here. Some bids coming into Apple and some of the tech stocks, not into some of the bank stocks and some of the more interest rate sensitive areas.
No, 22 out of 24 members of the KBW Bank Index closing down. Yeah. The group as a whole losing about 2%. There was quite a bit of demand for the 10-year note at the auction. The bid to cover ratio was the highest since February 2022. Yeah. Interestingly, that was just before the Fed began hiking rates.
Absolutely. Now, you didn't have it there on the screen there, but I want to point out that the biggest decliner here in the cash session was Paramount. And that's largely on a lot of rumors that were circling about Sherry Redstone scuttling that Skydance deal. We're now getting confirmation from National Amusements saying that it was not able to reach terms with Skydance on that deal that effectively would have peeled off Paramount, paid off Sherry Redstone, and put this sort of in the hands, of course, of Ellison Jr. there. National Amusements sending an emailed statement to Bloomberg and saying that it supports a plan announced by the office of the CEO.
This sounds like it's going to be a great TV series one day when this is all resolved.
I could see the Paramount.
Maybe it'll be on Showtime.
The Paramount Plus series coming next. If
yeah,
it's still,
it'll be on HBO actually.
Okay, all right.
I don't know how many people get Paramount Plus or pay for it. Separate issue. From
your lips to God's ears. When we come back, we're going to talk about a cautionary tale of being a little bit too acquisitive in the tech space. A look back at Compaq Computer's record-setting acquisition back in 1998 of Digital Equipment Corp. This is Bloomberg. All right, on this day, back in 1998, the PC maker Compaq completed its purchase of Digital Equipment Corp. It was a $9 billion deal that was then the largest ever acquisition in the computer industry. And while the deal vaulted Compaq to the second biggest player in the industry after IBM, it ultimately contributed to its downfall. Compaq was founded only 16 years earlier, 1982, three former Texas Instrument engineers drawing up an idea for a portable computer. By 1987, they were generating more than $1 billion in annual revenue, mainly selling so-called clone PCs. But by the 1990s, a deluge of even cheaper PC clones was crushing Compaq, so the company set its sights on the corporate market and the lure of recurring services revenue. Sitting on almost $5 billion in cash and an inflated stock price, Compaq held acquisition talks with several companies and in 1997 decided to pay $3 billion to buy Tandem Computers. That deal was followed 6 months later by Digital Equipment. It was an explicit salvo at IBM and its stranglehold on the corporate market. But as Compaq learned, if you come at the king, you best not miss. Selling services, it ain't as simple as building hardware. It requires legions of skilled technicians, which Compaq didn't have. Making matters worse, Compaq effectively bought a business that was suffering from stagnant sales, lagging market share, and more than $2.5 billion in losses over the past 5 years. That acquisition, it was a tipping point for Compaq, and it would join a list of high-tech mergers that never delivered on their potential. Think about the merger of Sperry Corp and Burroughs back in 1986 to form Unisys. They tried and failed to challenge IBM in the mainframe market. Or think of AT&T's hostile takeover of NCR back in 1991, a $7.5 billion deal that AT&T would have to spin off 5 years later at a lower valuation of just $4 billion. Or how about Silicon Graphics and Cray Research in 1996, which a decade later pushed that combined company into bankruptcy. As for Compaq, by 2001, just 3 years after making the biggest acquisition ever in the computer industry, that company threw in the towel, agreeing to sell itself to Hewlett-Packard, where its remnants remain today.
That was like a trip down memory lane. Compaq, Tandem, IBM, which of course is still around, Unisys, Silicon Graphics. You know, our younger producers hadn't heard of half the names.
Yeah, that's only for the grown folks, Scarlett, because
but you and I were like, oh yeah,
there's a whole cohort of people that had no idea what I was talking about.
Well, we had to spell it out for them with COMPAQ, right? All right, it's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up for us is Emmanuel Macron. The French president called a snap election, which follows an upset by the far-right party in voting for the European Parliament. First round of elections, June 30th. The second round, July 7th.
And a big event apparently tomorrow on Wednesday over there in France, where he's supposed to make an announcement. No one knows what it could mean. Another person I've been keeping an eye on is Mike Pompeo. Remember him? He was in the Trump administration. Now he's in private equity, because why not? Everybody is in private equity right now. The Wall Street Journal reporting that the former U.S. Secretary of State is now teaming up with the former folks over at One Equity Partners to build a new private equity firm. This is going to focus on mid-size technology companies.
And there's a lot of overlap, of course, between the tech industry and government. You have the CHIPS Act, you have critical technology tied to national security, so that's his new playground.
Yeah.
All right, third person I'm watching,
Who's that?
Dan Hurley. He turned down an offer to coach the LA Lakers.
What?
Choosing instead to stay in Storrs, Connecticut. Yeah. He wants to win a third straight championship with the UConn Huskies men's basketball team.
Yeah, I guess this shocked a lot of people, but then I feel like there are a lot of college coaches now, at least at these big programs, they don't really feel the lure of going to the pros, because I mean you have more control in college, at least in the college game, than you did going there. And whatever extra money he would have gotten, I don't know.
Yeah, well, Ned Lamont, the Connecticut governor, says he will be compensated for staying put. He'll make sure that he's the top paid college coach.
The governor said that?
Yes.
Okay.
There you go.
There you go. Interesting times we live in. All right, still ahead. We're going to get you on the edge on tomorrow's trade with what to watch for tomorrow. Stick around. This is Bloomberg. Two big market-moving events to keep an eye on tomorrow. CPI due out 8:30 a.m. Washington time, and the Fed decision at 2 p.m. Anna Wong, Bloomberg Economics chief U.S. economist, joining us right now to tie it all together. Anna, and let's start off with that inflation report. Are we going to continue to see maybe some positive signs in disinflation tomorrow morning?
Yeah, I think that the both headline and core CPI tomorrow will look softer than the previous month. So we're expecting a headline CPI monthly print of 0.1 and a core CPI of 0.3. But mapped to core PCE deflator, which is what the Fed cares about, it likely will look very nice at 0.2%, which is very close to the Fed's 2% target. So, yeah, I think the takeaway tomorrow would be disinflation seems to be on track.
What's going to be the big headline out of the FOMC announcement and press conference, do you think?
I think, obviously, the dot plot would be of focus by many people, and we are expecting 225 rate cuts in 2024. And I think more importantly would be the tone that Powell adopts at the press conference. And I think this would be an opportunity for him to provide the clearest signal yet on the calendar timetable of when the first rate cut could come. Yeah. And I think it would look to be September as of now.
All right. Well, the market, as we saw in the price action today, certainly on edge to learn something. Anna Wong over at Bloomberg Economics setting us up for two of the important events tomorrow, a few others to keep an eye on, including inflation data out of China.
That's right. And there's deflation, at least at the wholesale level in China. PPI seen down 1.5%, although that's an improvement from down 2.5% in April. CPI gaining about 0.4%.
Shortly after that, overnight, you're actually going to hear from the Bank of Thailand, a rate decision over there. But really, the big show is back here in the U.S., and it starts at 8:30 a.m.
Yeah, 8:30 a.m. we get the CPI numbers, we get core, and of course we get the headline number, and then that's kind of part of the drumbeat to the FOMC decision at 2 p.m.
Yeah, kind of interesting. Normally these two events don't happen on the same day.
Yeah, we get to obsess over it on two separate days.
Yeah, you think Jay Powell and company are obsessing over this?
I wonder if they have access to it. I mean, I know that the answer is they shouldn't, but...
Yeah. All right, well, 2 p.m. time, we are going to get the Fed decision. We kind of know what it's going to be, but as Anna Wong was alluding to, it's really about the summary of economic projections and the dot plot. The press conference at 2:30, and then after the bell, more earnings.
Broadcom will be reporting results. ADGO, of course, is the ticker, and we'll break that all down for you.
Abondo, remember that?
Yeah, no, back in the day.
Only those old enough to know.
Like Compaq, right?
Like Compaq. There. Thanks for joining two old folks here on The Close. We'll be back tomorrow with all your market moving coverage. In the meantime, Balance of Power coming up next on Bloomberg.